Hi, this is Alan Gassman. I'm here with Jesse Turtle and Grace Paul. Jerry Hesh is going to join us as soon as technology permits it. And we're here to talk about SPC, charity, and me. Today's emphasis is on charitable planning for the business owner. The business owner is a great contributor to any charity, including an educational charity in the community where the business owner would like to hire graduates and would like to see a better standard of education in that community. The business owner has specific opportunities and specific goals which may be different than a typical non-business related donor, and that's what we're going to cover today. For you Florida lawyers, we will be sending the course number and certification today in the afternoon. For you CPAs, we're going to be sending your certificate in the afternoon. So thank you very much for attending. Please note that you can send us questions. You can go to the questions panel, hit that little triangle, then you can type in your question. And if we know the answer or can take a guess, we'll answer your question. If not, we may email you later, and you can send any hard questions to Grace. Send me the easy ones by email. Let me mention that Saturday, we're going to continue our law firm series on estate planning, and we're going to talk about estate planning for business owners Saturday at 11 a.m. There is no continuing credit for that. In fact, if you tell the credit organization that you watched it, they may take away your other credits. So just keep it quiet. That's a free, interesting, and somewhat disorganized series that we have. Now, the SPC series, you can watch any of these. If you're on a computer where you can click to the recording, you can get straight to there from the PowerPoint. Alternatively, you can go to our YouTube channel. If you just YouTube Alan Gassman YouTube, you'll see that we have an entire charitable row down here under charitable planning, and you'll see our SPC webinars there and much more. By the way, if you would like an explanation of anything to do with the charitable world or anything to do with St. Petersburg College, just send us an email, whether it's to me or to Jesse, and we'll put something together just for you or just for your group. Because the objective here is to get information out to people so that charitable giving can be encouraged and charitable giving can be maximized. So let's not forget that. Now, Professor Hesh is going to join us soon. He is, in my opinion, the most well-loved and most well-respected law school professor of estate planning and taxation, and a great guy. He's done a lot of very interesting transactions helping medical law and colleges. So he'll hopefully tell us a couple stories when he gets in here. Grace Paul is a second-year law school at Stetson, a law student at Stetson. Yesterday, Michael Lehman let us know that he would not be able to attend because of a problem. So Grace has jumped in and learned some things, and she's going to tell you what she learned. And then Jesse, who are you and why are you here?
I have no idea, Alan. Why am I here? I'm the Vice President of Institutional Advancement and the Executive Director of the St. Pete College Foundation. So I've been here for just over 2 years, but have had a long career in higher ed philanthropy, starting at Eckerd College, which is my alma mater, which is right down the street, and then over the bridge at USF Tampa, and then back over the bridge to USF St. Pete, and now here at actually the best higher education institution in our region, St. Pete College. So with Dr. Williams at the helm, there's Professor Hesh. So that's why I'm here to lend my support in terms of philanthropy and how your philanthropic dollars or your clients' dollars can not only assist the college, but it really, the tide rises all boats. You know, when you invest in higher education, you're investing in our community, and then that is borne out year after year and generation after generation. So that's why I love fundraising, and that's why I love higher education.
And how many students do you have now at the college?
So we have, as we classify students, that's kind of every single person who comes through our doors, whether that's non-credit or credit. We have about 45,000 students that we serve on a yearly basis. AA students, BA students, certificates. Some of our students are here for 2 years, 4 years. That might transfer to some of the other universities in the state, or they might just get a short-term certificate and go to work. So we do all that. We service so many people, and so we're kind of the best kept secret in the county, and I'm sure everyone says that, but I think, you know, this is part of why we do these engagement opportunities with Alan, is to start to spread the good story of St. Pete College and get people engaged.
And I had dinner with one of your 35-year plus professors last week, and he teaches for you, and he teaches at another university, and he says what he loves about the SPC students is they care about what they're doing. They're there to get an education. They're not there to play. They're not there because they're rich kids and they had to go to some school whether they wanted to or not. These are a lot of adults and a lot of people who quite candidly are not wealthy and would not have been able to afford to go to a school if this four-year college wasn't in the community. So hats off for your dedication to this. So Jerry Hesh, who are you?
I used to be a full-time law professor for 25 years, teaching first in upstate New York and then at the University of Miami Law School. I'm no longer a full-time professor, but I'm an adjunct professor, currently teaching at 2 or 3 law schools around the country. And one of the things that I try to do is show people how they can actually give to charity and not cost them anything, and how to use charitable planning techniques to save them income and estate taxes. And the idea is what you can give to charity is the money you would otherwise pay in taxes, so it really doesn't cost you anything. But you can actually increase the benefits, so you can actually be better off by engaging in some of these charitable planning techniques than doing no charitable planning and selling an asset and paying the taxes. And so the key is the techniques are kind of complex. So the key is not to understand the techniques, but figure out how to communicate these techniques in an understandable manner so that the lay person can actually understand it and be encouraged to give to charity.
And Jerry, is it safe to say that many of the techniques that are available are simply not well known to many or most tax professionals, and that people like you who specialize in this area and who explore different ways to use the Internal Revenue Code have secret sauces? I'm going to call it some secret sauces that are out there. They're legitimate and they're legal, but they're not well known.
It's not secret sauces. It's more a question of to not only understand these techniques, the legal aspects, but you have to understand how they financially work. Because if you don't understand how they financially work, you might design them in a way that they will not be as effective as they could have been. And this requires not just understanding the law, but understanding how mortality tables work, how interest rates work, and how the financial aspects integrate with all this. And so it's not just understanding the legal stuff, it's integrating all the other disciplines. And that's hard to do. And that's why that's our objective today, is to like dummy it down so that at the end of this conference, Grace there will understand everything.
And explain it to us. And Jerry, you sent an email to somebody and you copied me on it a few days ago. And he had asked, what will it cost to understand and implement a charitable remainder trust? And I think your answer was, I'll draft the trust for $1,000, but it'll cost a lot more than that to make sure that it's going to be the right trust and that it's going to apply to you correctly.
Yeah, I mean, that's the key. I mean, everything has to be custom designed to take into account not only their income tax and estate tax objectives, but their station in life, their personal objectives, and their financial objectives. that requires a lot of integration, and that's why it's hard to do. And a lot of people like to say, oh, everybody gets a GRAT or everybody gets this, and it's easy to do. And so we're going on to the next level, and this is what we're going to be doing, is teaching everybody how to evaluate these techniques.
And then people like Jesse, with decades of experience in this area, can provide a lot of free information and a lot of guidance to help people come up to speed before they go to a tax professional like Jerry to get the suit actually fit on. So I wish there was one book that had all the information that you could read in a weekend and understand this, but it is a little bit more complicated than that. Now, I'm going to make an offer here, and that is I'm going to match your donations if you make these donations within the time parameters we're setting forth here. And what I'm going to give you is I'm going to match your donation, and I'm going to give you some books. And the books I'm going to give you are Build a Business, Not a Job. If you make any donation at all, I'm going to send you 5 copies of my friend David Finkel's book, Build a Business, Not a Job. And you will make your donation back 1,000 times if you just read 20 pages of this book. But also, I have my book on IRA inheritance planning. I have my book on Florida and federal asset protection planning, and we have our book on estate planning. If you will donate between $20 and $40, I will match your donation to the school and give you any one of those books plus 5 copies of David's book. If you give more than 40 up to 60, I'll give you any 2 of my books plus match your donation. And if you get up above 60 to 80, I'll match your donation and I'll give you all 3 of the books. And I will have Grace autograph the books if you get all 3 of them.
All right.
Page 15, we are in a very special microcosm last year and this year. In order to help people give more to charities, because charities definitely need more during the COVID virus, we have a special opportunity. And that is, if you are an S corporation, you can deduct up to 25% of taxable income as gifts to charity. It's normally been only 10%. And Grace is going to tell us about donating that inventory that you may not need or be able to sell anyway. And then for anyone, you can give up to 100% of your adjusted gross income and get a full tax deduction and pay 0 income taxes. So if you are a person or the advisor to a person who plans to leave a lot to charity on death, let's get it done now and get the income tax deduction now for what you're going to do when the client dies by funding a operating foundation with appreciated assets and then topping it off with cash. So very important, especially if you have clients with large IRAs. The annual limit for somebody over 70 and a half to pull money out of the IRA and put it into a charity has been $100,000 a year. Well, this year they could just take $1 billion out of their IRA and then donate $1 billion to the proper type of charity, a public charity like the school, or a private operating foundation so the family can control it, or a community foundation like the Pinellas County Community Foundation, and have that as a fund that can be used for charitable purposes and get a full income tax deduction now. So Jerry, anything you, or Jesse, anything you want to add to this? I'm going quickly, but
Alan, I have a question. If I have a bequest in my will of like $10,000 to my favorite charity, and it goes upon in my will, can I get a charitable income tax deduction for that?
No, but you could have made $10,000 of your IRA payable to charity, and then your family wouldn't have had to pay $10,000 of income tax. Or you could have said, put all my assets in the trust and pay the first $10,000 of interest income and dividend income from that trust to charity, and then your family would have gotten the deduction. Or donate the $10,000 now and get the deduction instead of leaving it $10,000 when you die. How was that?
To summarize, The general rule is when you have a charitable bequest, there is a charitable estate tax deduction, but generally no charitable income tax deduction unless you do one of the alternatives that Alan mentioned. And of course, if you want to give it while you're alive, that's easy. But for those people who still cannot afford to do that and want to wait to death, there are ways to make it available so you get an income tax deduction as well as an estate tax deduction.
Absolutely, very good. Now, quite honestly, the playing field is way too big in the charitable arena. This is an abbreviated chart that we developed for our own use and that you can use, but at least down on the left-hand side, you can have what we call a public charity, which does not have to be public, by the way, we'll explain more later, which receives all the tax advantages. And a big tax advantage of giving to a public charity is the ability to give appreciated assets, the ability to know that that charity needs to be properly administered or they will not be blessed by the IRS as a public charity, and the ability to put assets into the entity and not have to have them spent by any given time or distributed by any given time. Similar to a public charity, and actually a different kind of public charity, is the community foundation. And I like to mention the community foundation because they're local, they're warm, they're fuzzy, and they can accept a donation and actually come up with great ideas on what to do with it, just like St. Petersburg College can. So you don't, a lot of clients think of a charity as a place where they put the money and then they never see it again. But they could set up an account under a charity and then help advise the charity on how it is to be spent. Then you have your donor advised fund. That would be something like the Schwab or the Vanguard donor advised fund. You actually transfer appreciated stocks to any of these entities, but if you transfer them to the donor advised fund, you can actually sign on the account, control the investments until you distribute them to other charities, but get the tax deduction for making the transfer now. So if you are an itemizer, in other words, you're not always able to itemize your deductions for tax purposes. Instead of donating every year, you might donate every 3 years, make a very large donation this year, be able to write off that donation because you're well over your itemized deduction limit, and then dole it out to the charities from your community foundation account or your SPC arrangement or your donor advised fund every year. Then the private operating foundation. You can form a private operating foundation that will engage in some reasonable level of activity and be able to deduct the fair market value of appreciated assets that you give to the private operating foundation. And we represent several private operating foundations, and most of them have as an activity a close relationship with a school like St. Petersburg College, where the client makes the donation to the private operating foundation of an appreciated building or appreciated stocks. They get a deduction for fair market value. Then they take the income from those assets and they get with the college and they meet and greet applicants for scholarships. They award the scholarships. They mentor the scholarship recipients. They give awards for the recipients when they graduate. And that is a very, very good activity for family members to do. A lot of gratitude is expressed, and you can impact directly a lot of lives. That's the private operating foundation. And finally, the private foundation. The private operating foundation has to spend at least 4.25% of the value of its assets every year on activities and/or grants. The private foundation does not have to engage in an activity. It has to distribute 5% a year of the fair market value of its assets to appropriate 501c3 charities. Now, The other entity I would add to this that Jerry's going to talk about is the Charitable Remainder Trust. And with the Charitable Remainder Trust, you put assets in the trust, you get a small tax deduction. The assets can be sold by the trust to defer income tax, and the trust, after a period of time, passes to charity. And the tax savings can outweigh the portion that goes to charity. Now, across the top of this chart, I have a lot of different rules that apply to each of these entities and how they apply to each of these entities. And I'm not going to go over these rules, and there's going to be an exception to every one of these rules, and then often there's an exception to the exception, as my friend Jay Atkinson often says. So don't try this alone at home, but with some help from our friends, we can get these concepts understood to get to some practical arrangements. Page 20, I have a checklist of a lot of different ideas, but for the business owner, I have 4 ideas for you. One is to take a building that you have completely depreciated, it's not doing you any good anymore for tax purposes, and donate it to a school, a charity, or your own foundation. Get a tax deduction for the full fair market value, then let the foundation pay your child, nephew, or niece to manage the building, and take the rent income and donate it for a scholarship fund, and personally show up at the school, talk to students about how you made your millions, and help other people. So that's one of my ideas. My second idea that we're going to get to towards the end here is donate part ownership of your business to a private operating foundation or a public charity. There are rules that allow you to do this, and you get a tax deduction to avoid and reduce income tax by giving away something that really is not producing income for you, and that's part ownership of a C corporation. We'll talk more about it, but it can be very, very effective. Next, have a party for charity. You know, COVID-19, a lot of us are now out and about socializing. Have a party for charity. Your customers, your referral sources, and your charitable friends will love to attend the party. And you'll raise money, sometimes as much as you spend on the party, depending on whether you redecorate your house before you have the party. But talk to Jesse about a party, because little parties sometimes end up being very big projects. And then finally, when you have a dispute and somebody doesn't want to pay you, or you don't want to pay someone, offer to make full payment to charity or to accept a full payment to charity. Marcia and I, my wife and I, have a charitable giving goal that we reach every year. And part of it is reached by, say, when clients call up and say, boy, this costs more than I thought it would. Well, would you give that amount to St. Pete College? Okay, I will. All right, well, I check off that amount off of my charitable gift. And clients will appreciate that. So another idea here, or before I go on, Jerry, any comments on these ideas or thoughts for business owners?
Yes, you talked about fully depreciated buildings given to charity. There's one word of caution. If the building is still encumbered by liabilities, to the extent it's encumbered by liabilities, you will have to report gain. So it's a part sale, part gift transaction. So when you have encumbered real estate and you want to gift encumbered real estate to charity, there will be an income tax upfront cost that has to be taken into account.
And if you keep the debt on, then the rent income may be unrealized, unrecognized or taxable income, unless the debt is fairly old. And there's rules on that on the slide. Grace, Jesse, anything to add?
I don't think so.
It's a wonderful way. You know, we've done a few real estate gifts, you know, in the past, and obviously I think we hold on to those assets and then sell those, and then use the funds from the sale for the donor's intent of whatever they wanted to support at the college, if it's a scholarship or a program, or we work with the individual donor if it's something that is usable by the college. Then we could take it in our inventory essentially and say, hey, this would be something good that we would include in our real estate. I think the Allstate building in South St. Pete, that was actually a gift. So that's an illustration of a large commercial piece of property that was gifted to us many years ago, and that's where we have our police academy and EMT programs. And that's a huge asset to the college, many years, and then many years in the future. So it is a great way to make a charitable gift.
And if anyone donates a building this year, I will give you 500 copies of this book, Build a Business, Not a Job, which you can put in the building. Okay, Grace, here's your national debut. Tell us about charitable contributions of inventory, and I'll be glad to turn the pages as you tell me to or as you see fit.
All right, thank you for the wonderful introduction. So inventory contributions are probably something business owners aren't thinking about, but it can actually be really beneficial for a few different reasons. So obviously donating something to charity is for a great cause is great, but in addition to that, you can gain a lot of goodwill around the community for donating your inventory. And especially in a time where over the last year and a half, businesses may have extra inventory that they weren't able to sell with COVID. And this is a way to get rid of that inventory, receive a tax deduction, and do something for the community. So first we have a few different definitions. So the IRS defines inventory as property sold in the course of your business. So it's a pretty general definition. So anything you sell, widgets, water filters, masks, all that is going to be considered inventory for these purposes. And so the general rule is that businesses can deduct the smaller of the fair market value of the inventory or its basis. We'll get into later that C corporations can actually sometimes deduct more. And so then fair market value is defined as the price at which the property would change hands between willing buyer and a willing seller. So that's how much you can deduct. And we can go to the next slide.
I'm going to point out that the basis of inventory, you may think it's exactly what it cost you in direct costs, but I would think that your indirect costs can be allocated under cost accounting principles to your inventory. So it's more than exactly what the widget costs. It would include some of your general overhead if you have a good CPA who
not general overhead, but when you buy inventory, you have all sorts of costs like shipping costs, storage costs, and warehousing. Those can be added to your basis in the inventory. So what the key is, your inventory, suppose that your total costs for the inventory are $100 a unit and you sell it for $250 a unit. A lot of people mistakenly think, well, that's the price a member of the public would pay for it, $250, but unfortunately, you can't deduct the fair market value. It's only your basis in the inventory.
But if you're a manufacturer, I would think you could allocate.
Yeah, if you manufacture your own inventory, then if you manufacture your own inventory, then your cost accountants will already have all that done for you as to what your overhead allocation is. But the key is there's a lot of companies that have obsolete inventory out there, and they basically are going to sell it. They're going to try to sell it or for a distressed price or give it to somebody, give it to a outlet store. So in that situation, they can actually do good with it by getting a charitable deduction for the cost of their inventory.
Right. Go ahead, Grace.
And so an important part of this is making sure the organization that you want to donate to is an eligible organization so that you can receive the tax deduction. Luckily, the IRS makes that pretty easy. So you can actually go to this link here and you can look up the organization that you would like to donate to make sure that they are a qualifying organization. And you can also look over here to the right, they have this little quick check chart so that you can just kind of look and see if you're not sure, you know, who or what you want to donate it to. So that's also really helpful as well. And so we have some different rules for food inventory. So in general, normally businesses can deduct 10% of their taxable income. But for food, it's normally 15%. But with the CARES Act for 2020 and for the Consolidated Appropriations Act in 2021, all companies, C Corps, S Corps, partnerships can deduct up to 25% of their taxable income for food inventory.
But they're still limited to the basis, right?
Yes.
Okay.
Yes, they're still limited to the basis. And there's also a restriction on the types of food you can donate. You can see there it says apparently wholesome food. So these are just typical FDA requirements. Please don't poison any charities you wish to donate food to. These are just pretty easy requirements that I think most people will be able to understand about what's good food and what's not. So that's contributions for food. And then we'll get into the specific rules for C corporations. So C corporations are really the ones benefiting the most from the CARES Act. So corporations can deduct all charitable gifts up to 25% of their taxable income, including food inventory. So it's really whatever C Corps want to donate. And this is a big jump from the normal 10% of other charitable gifts of inventory that C Corps could donate prior to the CARES Act.
What about an S corporation?
So S corporations, I think it's the next slide. S corporations can only get still 10% for everything else, but they're at 25% for food.
Okay.
Jerry, what if the S corporation invests in a partnership and the partnership makes the donation? You think you can?
It's a pass-through entity. In other words, the deduction passes through to the individual shareholders. That's the key. So they can have their company. See, in a C corporation, you can't pass the deductions through the shareholders. S corporations, it's a pass-through. So basically, you can get that charitable income tax deduction made by your S corporation on your individual income tax return.
So when next year, when the maximum deduction is 60% of adjusted gross income, will I be able to deduct 60% of adjusted gross income plus I won't have to pay? I'll get the equivalent deduction if my S corp donates 25% of its taxable income?
No, it's all aggregated through on your individual return.
Oh, okay. All right. And then what happens with partnerships, Grace?
So partnerships are similar to S Corps, where they can get up to 10% deduction of their taxable income for all the other inventory contributions, and then they also get the 25% of taxable income for food inventory. And so similar to an S Corp, the partners account for this on their personal tax returns. Okay. And then here we have just a summary of what the CARES Act has changed. So that 10% to 25% for food inventory, and that additional 25% for C Corps for everything. And then the Consolidated Appropriations Act extended that through calendar year 2021.
So Jerry, do you want Grace to write you a 30-page paper on this? Great job. Next time I go to the mini mart, I'll be thinking about all this food that could be donated to charity, but that none of it's healthy. So I guess Slurpees probably wouldn't qualify, right?
Probably not.
Or day-old bread, and what's the fair market value of day-old bread? I'm sure that that's subject to living. Another idea for the business owners, or at least for the professional practices, I have this in a lot of my fee agreements, that if there's money left over at the end of the engagement, the first 500 of what's left over will go to my chosen charity, and then I will give the equivalent amount to the client's chosen charity. And I do this sometimes when I'm just not sure if a client is going to be a good fit. So I put that in there. If the client calls my intake people and says, that's outrageous, that's crazy, we want nothing to do with $500 going to charity at the end of the engagement, then I know I don't have a good fit. But if they don't complain about it or they compliment it, then I'll be willing to take them as a client. So it's just something to think about. Page 32, more about the private operating foundations and scholarship programs. And if anyone has a client or would like to do something like that, I have a longtime client that does this with St. Pete College, who Jesse knows, and that client will be glad to talk your ear off about how good he feels about doing this for veterans. His niche is to find veterans who have come back from the service and have come back to our community and otherwise probably wouldn't go back to school to get a vocational career or a 2-year or 4-year degree, but for the fact that my client will mentor them and pay for their education, because he feels like you're not only educating that one retired soldier, but you are supporting an entire family. And that's very important to him. Jerry, you told me yesterday about donating the goodwill of a business to a charitable trust. Do you want to talk about that?
Okay. Well, let's suppose that you have a highly appreciated asset, and there's an impending sale of that asset, like your closely held business. And let's simplistically say that you have a interest in a closely held business worth $10 million with $1 million basis. And if you sell it for cash, you'll have a $9 million capital gain and have to pay the income taxes on that capital gain up front and have the after-tax amount to invest. Interestingly enough, if you contribute that appreciated asset to a charitable remainder trust, and the charitable remainder trust now owns the asset, and the charitable remainder trust is not subject to income tax. A charitable remainder trust is not a grantor trust. It's a regular complex trust. So when the charitable remainder trust realizes that 9 million gain, it doesn't pay any tax. So essentially, the principal in the charitable remainder trust has 9 million of gain that the charity realized but didn't pay tax on, and 1 million of basis. And so what happens is the charity invests that 10 million in an investment portfolio that, say, produces a 7% rate of return. No, make it let's do it conservative. It produces a 5% rate of return. So what happens here is the charitable remainder trust is essentially the practical equivalent of placing the principal into a trust and retaining the income from the principal for the rest of your life. So if you have a 9 million gain, with say $2.5 million of income taxes on your 9 million gain, so out of the $10 million, you pay $2.5 million of income taxes, and you have $7.5 million to invest. And all of a sudden, I can get the income for the rest of my life for $7.5 million. If I put that appreciated asset into the charitable remainder trust, and the charitable remainder trust sells it and doesn't pay tax, you now have the income instead of from $7.5 million, you have the income on $10 million for the rest of your life. So it is a way of increasing the amount that you can invest to generate income. So that's the, and that's the first advantage of charitable remainder trusts. Would you rather have the income from $7.5 million for the rest of your life, or the income from $10 million for the rest of your life? And the answer is obviously yes. Now, interestingly enough, remember that trust principal has the $9 million of gain that the charity didn't have to pay any tax on, and you retain a right, and the charitable remainder trust only earns 5%, or 5% on 10 million is how much is that, Gail? Grace, can you do the math in your head? 5% on 10 million?
500,000.
I went to law school because I can't do math.
All right. 5% on 10 million is $500,000. Okay. So all of a sudden, at the end of the year, the charitable remainder trust has $10,500,000. But the charitable remainder trust doesn't have to just distribute the income. It could distribute an amount greater than the income. As a matter of fact, it's fixed. So based on the charitable remainder trust terms, let's suppose that the distribution for the first year is $800,000. So what happens is you get $800,000. Only $500,000 is the income that the 10 million earned. The other $300,000 is out of trust principal, and trust principal has 9 million of gain and 1 million of basis. So out of that trust principal of 300,000, you report 30,000 as a return of basis. Oh no, wait, yeah. In other words, out of that trust principal, it comes out as capital gain and return of basis. So what you do here is not only do you get income from a greater amount, the before tax proceeds, but anytime the distribution is greater than the trust income and it comes out of trust principal, it conduits out that capital gain. So all of a sudden, this becomes a very nice income tax deferral transaction on that capital gain, because every time you invade trust principal to make up the charitable annuity payment or the charitable unit trust payment, it conduits out the built-in gain and built-in basis in the trust principal. So charitable remainder trusts, unit trust or annuity trusts, are a wonderful opportunity to defer the reporting of the gain on an impending sale of an appreciated asset. That's in very simple terms. Alan, you want to add any other comments?
When do you have to make the gift? Can you make the gift while you're under contract to sell?
There's a little quirk. That is, you can make the gift as long as the final sale terms have not been negotiated. For example, you have a letter of intent, or you have an offer and you're negotiating the final sale terms, but you can make the gift of an appreciated asset as long as the sale terms haven't been agreed upon. Once all the sale terms have been agreed upon, are locked in, and you make the gift to the charity after the fact, the IRS, in a number of cases that it's been successful, has said, you're not giving an appreciated asset to a charity, you're giving the right to a future sale proceeds that you already earned, and therefore you have to report the entire gain when the charity sells it. So the key is, the client comes to you, you got to tell them this before the final sale terms are all locked in, as long as there's some contingencies. In other words, once that contract becomes locked in, the closing date occurring later is irrelevant.
Okay, we've got some questions here from the viewers. One thing is, how do you make an annual annuity payment if what it owns is a C corporation or an asset that's about to be sold? that does not generate income.
Well, wait. The asset that's going to be sold does not generate income?
I think the answer is before the first year is over, the asset's been liquidated and you have plenty of money to make your annual distribution.
Yeah. I mean, the key is you contribute the appreciated asset to the charity, and it takes 11 months to close. Well, that's okay, because the charitable payment it can be made 1 year afterwards, after the contribution in trust.
And then
Of course,
Stephen wants to know if you get a charitable deduction for donating an appreciated asset to a charitable.
Oh, that's right. I forgot about that. You also get a charitable income tax deduction equal to the present value of the remainder interest that goes to charity. So if I did a charitable remainder uni trust and I maximized the uni trust percentage and I put $10 million in, not only do I get the ability to get income on the before tax amount, and not only get the capital gains deferral, but I can get a upfront charitable income tax deduction equal to the present value, and but it has to be a minimum of 10%. So yeah, so that's another factor, that is, you get this wonderful charitable income tax deduction up front, not of the entire amount, but the present value of what will go to charity in the future.
Then Joyce wants to know, if I have stock that is not going to pay a dividend and not be sold for several years, is it still practical to use a charitable remainder unit trust? And I would say yes, if you use what's called a net income makeup charitable remainder unit trust.
God, what the hell is that, Alan?
That is something that we spoke about 3 sessions ago that would take an hour to explain properly and 20 minutes to explain improperly.
Well, how about 2 minutes?
Okay, it's a charitable remainder unit trust.
It's a net income makeup charitable remainder unit trust, or NIMCRUT. That's a mouthful.
Right, and Peter Piper had peckers that he donated into that. So you don't take your payment every year. Instead, you only will get your payment and makeup payments when the stock sells. And there can be a lever, or what we call a switch to flip, in the trust, which says if and when this stock ever sells, then I'll get all the payments that I would have gotten over the years, and they'll be calculated based upon the same percentages would have applied without reduction for any distributions having been made. So in year 14, when you flip that switch, you get a very large payment, more than you would have gotten if you had gotten payments every year, the way the math works.
To translate, if you put in so let's suppose you put in a asset worth $10 million that doesn't pay any dividends, all right? And the net income makeup charitable remainder unit trust basically says you don't have to make any payments until the trust actually has income. So what happens in that situation is, if it doesn't have income in the first few years, no payments are necessary. You only have to make payments when the trust actually has the income needed to generate the distribution. And the other advantage is all the payments that weren't made in the prior years can accrue and be made up when there's actually income in later years.
Okay. Now there's other kinds of, we're going to skip this slide, but just for those of you who work in this area,
you can't read it, so don't worry.
Compare the charitable remainder trust to the charitable gift annuity to the pooled income fund. The print is small, but if you buy 3 books at $81, I will send you a magnifying glass. All right. I want to show you slide 42 because it works well. This is a transaction that Brandon and I recently completed. The client had an investment in a C corporation, and he owned about 65 or 74% of it through an S corporation. So about a year before the sale, we set up a spousal limited access trust for the spouse and a descendants trust for the children. And this S corporation pledged to the client's private foundation that it would donate 10% of the value and dividends of this company within a 3-year period. So anything it received as dividends or from sale for 3 years would be held up, and it would eventually donate this to the foundation. So about a year before the sale, we valued this company, took a discount for non-voting member interests, and did an installment sale. And the value of this company was reduced by the portion that was going to go to charity. We did that. Then about a year later, this company had explosive growth in value. It basically doubled in value because some of the things that the client was hoping would happen did happen in the market and with the products. So at that point, just before this company was sold, the S corporation donated the stock, the percentage of stock of the company, to this foundation to get a charitable deduction and to keep this portion of the value of the company not being subject to income tax. The rest of the company was sold. The client's share of the proceeds went to the S corporation. So now there's been a lot of estate tax savings. There's been a healthy income tax deduction. We were able to do this in the same taxable year. So the taxable year of the sale, which generated a lot of net income, allows the S corp to get a deduction for the percentage that was sold to the charitable foundation. So now the charitable foundation is fully funded. The client is going to do a very interesting charitable project, and the client is now going to be living mostly from the income from these promissory notes. And as his future investments go up in value, they will not be subject to estate tax. Another thing I want to show you is a client came to us and said, I'm very charitable. I want to leave $8 million plus my houses to my spouse, and then I want to leave everything else to my 501c3. And that was very impressive. And I said, what is everything else? And he said, everything else is mostly S corporations. Well, S corporations can be owned by a 501c3. But if you get too much in dividends, you could lose your 501c3 status. So and plus a 501c3 is subject to a lot of limitations, because one thing he wanted to do was he wanted to benefit his ex-employees. There's probably 1,000 people within a 100-mile radius of where he lives who are his ex-employees. And he would like for them to get some educational and retirement benefits, which you can't do with a 501c3. You can't benefit named individuals. So we said, well, you'll have about 11.7 million of exemption left. So let's not leave it all to charity. We'll leave 11.7 million to a credit shelter trust for charitable and benefit purposes. So now this entity can own the S corporation interest without a problem, and it will pay income tax except to the extent that it donates to the 501c3. So this is just an idea. If you have clients that are leaving it all to charity, make use of that 11.7 million in a way that this entity will not be regulated like a 501c3 would. Now, Jerry, maybe you can help me for a minute to understand something that really most planners don't think about or know about, and that is the administrative note exception. And the way I understand this is that if I were to die owning a $20 million business, I could provide in my trust that the $20 million business would go to charity unless my children buy it for a note. So my children would have an option to buy this company for a note. So instead of my children inheriting the company and paying Uncle Sam 40% of its value, my children would get the company and pay no tax, but would owe a $20 million, 25-year fair market value rate of interest note to the charity that the charity may be willing to give a discount on if they would just pay the charity half of that money up front a few years after my death. Then they could own the business and they could deduct the interest payments to the charity. Did I explain that correctly, Jerry?
Yeah, so essentially what you're saying is I have this business that's worth $20 million and I want to give this business to a charity. The problem is the business generates unrelated business taxable income, it generates excess business holdings, and there's all sorts of excise penalties and problems to give an operating business to a charity. You just don't give operating businesses to charity. They don't want operating businesses because of the unrelated business taxable income and the excess business holdings problem. However, you want the charity to get the profits from the business. Okay, that's really what you want. So what happens in this situation, you leave the business to the charity under this very obscure rule that nobody really knows about. You should have basically said administrative note obscure exception. Okay. The charity can sell the business to the children for an interest-only promissory note, i.e., the children don't have to pay any cash up front to buy the business. It's 100% seller-provided financing. And so all that happens here is, very simplistically, the children can buy the business for 100% seller-provided financing, and now all that the charity has is passive interest income from the sale of the business, and it can go on. But the problem is that the kids have to pay the charity the money on the promissory note 25 years in the future. And we're not going to get into what's the value of the business and discounting. So it's simplistically, it allows the children to purchase the business with no money down and pay, and the children basically get a deduction for the interest expense because it was incurred for the acquisition of an income producing asset. So it's just a kind of a nice thing, but you have to caution at the end of 25 years, the children got to pay the principal on the promissory note.
But I misspoke. I see here, and remember, the note is at the applicable federal rate. So it's about a 2% note, which is quite a good opportunity. So
that's right.
years,
in other words, the children can purchase the business at 2.1% interest rate today.
So certainly after the IRS audit period is over, the children can approach the charity, and if it's a public charity, and renegotiate that note. So that feels better than paying estate tax. The last thing I'm going to mention is a Lissy article that I wrote with John Beck and Michael Lehman called The Donor Controlled Charitable Business System. And what you can do is set up your private operating foundation and a special kind of irrevocable trust that's held 35% for family members, 65% for charities and either cemetery associations or police benevolent associations. Don't ask me why, it's in the article. That can own the voting stock of your business, your C corporation, and then you can donate the 99% non-voting member interest in the C corporation to a private operating foundation, get a tax deduction, and now you can do transactions with this C corporation once the private operating foundation becomes a public charity. And you can convert the private operating foundation to a public charity by having it operate a school, which could be on the campus of St. Petersburg College, under the auspices, the shared auspices of your family and St. Petersburg College. And we have a private letter ruling that gives us a roadmap on how that was done for a veterinary school not very long ago. So here the client pays no estate tax because this can happen on death. The client's children can be the trustee of this note. This does not violate any of the rules. It doesn't qualify, the trust is not a disqualified person. There is no prohibited transaction here. And the family can control the public charity as well. So there's lots of opportunities here. Our time is up. I want to thank Jerry very much. Thank you, Grace. And Jesse, I want to give you the final word on what it feels like to essentially dedicate a large portion of your life to charitable purposes, because we know that people in your area are underpaid, and you've elected a profession that is underpaid in money, but I think overpaid in happiness and sense of well-being. So what are your closing thoughts and statements? Unmute.
I love what I do, and I get to help businesses and individuals have them make an impact, and that makes me feel good that I'm kind of the one that's able to make these partnerships. I'm passionate myself about higher education. I was a scholarship student, would not have been able to go to school without scholarships, so it's a great, pay it forward for me to be able to make these connections. So, SAPE College, like I said before, the tide rises all boats. Our alumni stay here. USF alumni or Eckerd alumni, not me because I stayed, but they all go off to other areas, and they're out and about in the whole country. So we're investing in our future and our community members. And like you said, our students are 27 years old. They work. They have children. These are families. This is not no offense, Grace, but we have some of the traditional age students, but the students at SAPE College, they're firemen, they're nurses, they're EMTs, they're they're the next investment person. They're the next CPA. We have a great accounting program that transfers to USF. So I just feel good about SAPE College and what I do, and I get to help other people help people. So that's why I love what I do.
That's beautiful.
Thank you, Alan, for the opportunity. A lot of this stuff is very complicated, so it's nice to have someone like Alan and certainly Professor Hesh in the corner to help navigate some of these complicated charity, gifts, really.
Okay, so I hope that all the attendees will share at least one or two ideas here with your clients. If you don't share these ideas with your clients, they won't know about them, they won't do them. But if you share the ideas, wonderful things can happen. Thanks again to everybody. Have a fantastic afternoon.
Thank you.
Thank you.